Vô chứ làm cái gì nữa. Lẹ. Cho tôi xin cái thọt này được không? HD10. Xin HD10.
Để làm nóng người, hiểu không?
WeMasterTrade.
Welcome back to WeMasterTrade family, it's me, Adam here, and oh my god, it's excited to be here today for another incredible live session. Whether you've been with us for a while or this is your first time joining, buckle up because we've got a jam-packed session full of insights, strategies, and the kind of tips that will take your trading game to a whole new level. So, are you ready to crush it today? So we've got traders tuning in from all over the world, and it's awesome to see that everybody coming together to share, learn and grow. So let's keep the momentum going, because today's session is going to be next level. So we've got some special guests here who are here to share their stories and strategies that help them rise to the top of their game. So trust me, you don't want to miss a single word. So first up, I have the honours of introducing Scarlett, an absolute beast in the Forex market. So Scarlett's been mastering Forex trading for over 2 years and a half, so she's here to share some seriously valuable insight with all of you. So Scarlett, how's it going?
Hi, Aidan. I'm feeling fantastic and thrilled to be here. It's always wonderful to engage with the WeMasterTrade community and discuss the successful approaches I've recently adopted. I'm eager to delve into some of the strategies I've been applying in the Forex market.
So I love that energy, Scarlett, but I know the audience is bummed to hear all about your Forex journey. But before we get into that, let's not forget about our next guest, Helen. So Helen's been dominating the fund trading scenes, especially in the high-stakes world of crypto and stock. So Helen, how's it going?
Hey Aidan, I'm equally excited to be here. This session always offers fresh topic for discussions, and today I'm here to share some of the strategies that have been effective for me in fund trading. It's going to be an engaging session.
But we'd love to hear, so for everybody watching, make sure you've got your notepad ready, because Scarlett and Helen are about to drop some serious knowledge bombs. And we'll be diving deep into their experiences, challenges, and the strategies that will help them thrive in the fast-paced world of fund trading. Okay, Scarlett, let's kick things up with you. So you've been trading Forex for over a year and a half now, and I know that the Forex market can be a bit of a roller coaster. So can you tell us how you got your start in Forex trading and what led you to choose WeMasterTrade as your platform?
Certainly, I began Forex trading about 2 years ago. What captivated me initially is what the market's vibrancy and perpetual activity. The Forex market is exceptionally dynamic, and I was attracted to the concept that there is always potential for success regardless of the circumstances. When I first discovered WeMasterTrade, it immediately resonated with me as the perfect match. The resources they provide, including sophisticated technical analysis and access to real-time data, truly impressed me. However, it was the community aspect that granted it for me. WeMasterTrade places a strong emphasis on aiding traders' success by offering essential tools and support to advance regardless of your starting point.
So that's fantastic, Scarlett. It sounds like WeMasterTrade has really helped you evaluate your game. Now, Forex is known for its volatility, and sometimes they can make or break a trader. So how do you handle the ups and downs of the Forex market without letting the pressures get to you?
Great question, Aidan. Volatility can be challenging, but it's also where the real opportunities are. The key is having a solid risk management plan, and I always say you have to respect the risk. It's important to stay disciplined, and WeMasterTrade risk management tools help me do that. Their real-time alert and customizable risk parameters allow me to react quickly but with control. When the market moves fast, you have to stay calm, trust your strategy, and not let emotions take over. And for me, that's where WeMasterTrade features really shine.
So that is some seriously valuable insights, Scarlett. Managing risk and staying cool under pressures is definitely key in Forex trading. Now, Helen, let's switch gears to fund trading. So you've been crushing it for nearly 2 years, right? Specializing in long-term strategies. So can you tell us what drew you to fund trading and how it differs from other forms of trading?
Absolutely, Aidan. Fund trading revolves around strategic long-term growth. It's not about seeking quick win, but constructing a portfolio that can steadily expand over time. What really distinguishes fund trading is the need to consider both short-term and long-term perspective. Careful risk management is crucial, while substantially keep an eye out for emerging opportunity. WeMasterTrade real data and analysis tools have been instrumental in achieving this balance. They enable me to make well-informed decisions that align my long-term strategy, even when my market presents unexpected challenges.
Ooh, I love that. Fund trading definitely seems that it requires a lot of patience and foresight. So how do you stay focused on the bigger picture, especially when the markets get rocky?
Patience is paramount in fund trading. The market experiences fluctuation, but short-term up and down shouldn't dictate your long-term strategy. A crucial lesson I learned is to maintain emotional detachment. Don't get overly excited when things are going well, and don't panic when the market dips. WeMasterTrade risk management tool assist me in staying disciplined even during volatility. I can set a reside rate parameter and have a peace of mind, knowing that I'm not over exposed even when the markets behave unpredictably.
So that is such solid advice. Keeping your emotions in check is, I believe, a very big part of being successful in trading. So you both have shared some serious gems so far, but let's talk about the tool that will help you to get to where you are today. So Scarlett, could you share more specific features in WeMasterTrade that has been a game changer for you in Forex?
Definitely, a tool I absolutely rely on is the Account Insights feature. It offers up-to-the-minute data on how my account is performing, and I use it to observe patterns, evaluate my trades, and make better informed choices, whether I'm pinpointing the best times to enter the market or deciphering market trends. These tools give me an edge. It has enabled me to spot opportunities that I might not have noticed otherwise.
So that sounds like a total game changer because real-time insights is crucial, especially when you need to make quick decisions. So Alan, how about you? What's been your go-to tool in fund trading?
For me, it's all about the risk management tool. They allow me to customize the amount of risk I'm willing to take on any trade. This has been key for me, especially in a volatile market like crypto. WeMasterTrade helped me stay disciplined and in control, ensuring that I never take on more risk than I'm comfortable with. That's what keeps me grounded even when the market is going wild.
So I believe the risk management is really important here, especially in today's fast-moving market. So whether you're in Forex or fund trading, having the right tools makes well look different. So I hope that everybody's taking notes because Scarlett and Helen are dropping some serious pot level insight today. Alright traders, we're kicking things up a notch because it's time to dive into one of the most powerful features here at WeMasterTrade, the package comparison. So whether you're a fresh paint newbie, eager to get your feet wet, or a seasoned pro looking to scale your strategies in new highs. So I believe that this segment is for you because this is where you'll definitely find the perfect trading package to notch your flaws and take the trading to good to great. Okay, so now to be clear here at WeMasterTrade, we know that there's no one-size-fits-all in trading. Every trader is unique, so with different style, risk tolerance, and strategy. So that's why we offer multiple customizable packages to meet you exactly where you are in your trading journey. So whether you're aiming for high risks and high rewards, or you prefer the steady, methodical approach, there's something here for you. And to break it all down, I've got the awesome Helen and Scarlett, two WeMasterTrade finers. So they are both work closely with these factors and are here to give us the inside scoop on how to leverage each one to its fullest potential. Alright, let's jump in, Scarlett. You've been at WeMasterTrade for a while now, and I believe that you've seen firsthand how these packages can validate your trader experience. So can you kick things up and walk us through how both new and experienced traders can benefit from the package comparisons, and why is it a game-changing experience, in the WeMasterTrade experience?
Absolutely, Adrian. I really enjoy discussing these packages because it's where traders can truly customize their experience. The package comparisons filter simplifies the process of traders to understand precisely what they are getting, When you visit the website, there's a detailed comparative overview of each package that includes information like the initial balance, profit targets, the loss limits, and more. All the essential details are presented in a straightforward, easy to navigate table. It's all structured to assist traders in selecting the best tools for their success. Let's talk about a standard package. One of the most popular options. This one is great for traders who got some experience and are ready to level up. You start with an initial balance of up to $200,000, which gives you plenty of room to trade confidently and make strategic moves. The profit target is set at 6%, which is perfect for traders aiming for steady, sustainable growth. And the loss cap is 4%, so you got enough breathing room to ride out market swing without stretching too much. It's an awesome balance between opportunity and security.
So that sounds like a perfect stepping stone for traders that can discover up without jumping in too deep or too quickly. A 200,000 day balance and a solid 6% profit target, I believe, gives you a ton of flexibility to build momentum. But for those who are looking for something that is more thrilling, so let's talk about the 5-10-10 package. So Scholar, I hear which one a favorite for high reward traders. It will make the 5-10-10 such a standout.
Well, about a 5-10-10 package, now we're talking big plays. Like the standard package, you start with $200,000, but this package is for those traders who are ready to take on bigger risk for bigger rewards. The daily loss cap is 5%, giving you more flexibility in how you can handle the market. But here's the kicker, the profit target jumps to 10%. This is perfect for traders who have confidence in their strategies and are looking to make those major gains. It's all about having higher tolerance for risk and exchange for bigger payouts.
So now that we're talking about a 5% loss cap and a 10% profit target, that's definitely for traders who aren't afraid to go big and swing for the fences. But what if someone's looking for something more relaxed? Maybe they want something simpler without all the pressures of a specific profit target. So Alan, I heard about the 5-10-0 package, so can you break it down for us?
Absolutely, Aiden. The 5-10 euro package is ideal for traders who want a straightforward, no-nonsense approach. You start with a 100,000 balance, but here the cool part, there is no profit target. You can trade freely without stress of hitting specific percentages. It's just you, the market, and your strategies. Daily loss cap stay at 5%, giving you some structure, but the beauty here is that it allows traders to focus on consistency without worrying about specific growth.
So that sounds like a brain for traders who just want to trade without all the restrictions. Talk to freedom, no pressure, just you and the market. Now, Helen, what about those traders who want a bit more control over the risk management, but still want to play in their high-stake arena? So what can you tell us about the 5-10-10 no PC package?
The 5-10-10 no PC package is perfect for traders who want more control over their trades. You still got the 200,000 starting balance and the 5% daily loss cap, but the flexibility is the real selling point here. This package allows you to track and adjust your trading parameter to match your style and risk management preferences. Whether you are reacting to market trends or want to experiment with different strategies, this package gives you the freedom to adapt without losing the safety net of risk management.
So flexibility and control in a volatile market, that's huge, and a lot of these packages are giving traders more ways to adapt and grow. So now that we've covered a lot, but I've been hearing whisper about something really special with the custom package. So Scholar, tell us, what makes it one so exciting?
Okay, then the custom package is where things get really exciting. It's for the traders who want full control, full customization, and a massive starting balance. You get a jaw-dropping $400,000 initial balance. Yes, that is $400,000. But that's just the beginning. The real beauty is that you can customize everything. The daily loss limits, overall loss limits, and even your profit target. It's perfect for traders who know exactly what they're doing and want to craft a trading experience that matches their exact needs. Is the ultimate in freedom and control.
So a 400,000 starting balance and the ability to customize your entire trading experience. So that's, I believe, the next level trading. So whether you're a risk taker or methodical trader, the custom packet sounds like the ultimate playground for those who want to take their trading to the stratosphere. Alright, so let's quickly recap. So we're just getting started with the starter package with going bigger reward, the 5-10-10 package, or enjoying full freedom with 5-10-0, taking control with 5-10-10 no PC, or customize everything with a custom package. WeMasterTrade has the option for you. So the only question is, which one is calling out your name? So head over to the mechanism section on our website right now and check it out for yourself. So reward package is designed to fit every trader, no matter where you are in your journey. Let us know in the chat. We can speak to you, and our team is ready to help you get started. The future of trading is in your hands, so let's make it happen. Alright, traders, so this is where magic is going to happen, okay? So we've talked about the packages and how you can jumpstart your trading journey with WeMasterTrade, but let's be real. It isn't just about the package that you choose, it's also about understanding and sticking to the rules. So it's also about sticking to the rules of the conditions that we accept here at WeMasterTrade are designed to not only keep you safe, but also to help you grow and take your strategy to the next level. So now we're just getting started, like you've been trading for years. Practice your roadmap. So let's dive into the rules and define our trading environment, because if you understand the rules, you can master the game. So first on the list, and arguably one of the most important, is the daily loss limit. So Alan, you've been through it all, the high, the lows. Can you kick things up by explaining to everybody how this daily loss limit works and why it's so crucial for managing risk?
Absolutely, Aiden. The daily loss limit is one of the most essential solutions any trader can employ. It serves as a daily circuit breaker to prevent you from suffering significant losses on a challenging day. The concept is straightforward. There is a limit to how much you can lose in a single day of trading, and it's determined by the ratio of two values: your account balance and your equity at the beginning of the day. Okay, let me break down with an example so everyone understands it clearly. For the 1st December, let's say you got the balance of the 105,000, but due to some open trade, or your equity, which is including floating profit and loss, is 107,000 at the start of the day. If you're working with a 4% daily loss limit, that means you can lose up to 4,000. If your equity falls below 103,000, you don't trading for the day. For the next example, on the flip side, if your balance is 100,000 and your equity is 99,000, the same is 4% loss limit. Even your account could be liquidated if your equity is below 96,000. The point is, the daily loss limit is to make sure the bad day doesn't whip you out completely. It's about protecting your account and giving you a chance to regroup and come back stronger the next day.
So just to clarify, if I hit the daily loss limit, so can I continue trading the next day?
Great question, and I don't know if you breach the daily loss limit, your account is automatically liquidated. All your open positions will be closed and you won't be able to trade again, or unless you buy a new trading account. So here's the thing, this liquidation is automatic and immediate. It's designed that way to prevent further losses, but here's a word of caution. Market fluctuations can sometimes cause you to lose a bit more than the limit. depending how fast the market is moving.
So it's a hard start, definitely something traders should keep an eye on to avoid. And now that we have understood what the daily loss limit is and what happens with a hit, the next question is how to avoid hitting a limit in the first place. So, Alan, you've been trading in the trading chain just for years. Can you share some practical strategies as traders can use to stay within the daily loss limit? We're all ears.
You got it, Aiden. Staying within the daily loss limit is all about being disciplined and following a solid risk management plan. Here are some few key strategies that have worked wonderful for me and countless other traders. First, and I can't stress this enough, overuse a stop loss. I know it sounds simple, but it absolutely is crucial. The stop loss ensures that if the market moves against you, you're out of the trade before things get out of hand. Think of at your safety net.
So that's like setting up guardrails on a mountain road, right? It says to stop you before you go off the cliff.
Exactly, then it's that extra layer of protection. Now the second strategy is position sizing. This is where a lot of traders bluff. You should never risk too much on a single trade. A good rule of thumb is to risk no more than 1 to 2% of your account balance per trade. This way, even if the trade doesn't go your way, you still far from hitting your daily loss limit, and you can keep trading without any major setback.
So it's like building your defense, you don't build everything in one play, right? You spread out the risks, makes sense, but what about those moments when traders feel tempted to chase after the losses? Trying to get it all back in one trade?
Oh, that's the big one, Aiden. Chasing losses is one of the biggest mistakes traders make, especially new ones. This brings me to my third strategy: don't chase losses. If you're having a tough day, take a step back. The market will always be there tomorrow. If you start chasing losses, trying to recover too quickly, it's easy to make emotional decisions that can lead to even bigger losses. And before you know it, you hit that daily loss limit and you're out for the day.
So true. It's like trying to sprint when you're already winded. You're more likely to make a mistake. Now, all of these strategies sound spot on, but how do traders stay mentally strong when things aren't going their way? What keeps them from falling into the emotional trap of chasing losses?
It's all about mindset, Aiden. Trading is just as much a mental game as it's a number game. You got to stay calm and focused. One thing is to always have a trading plan for you even when you trade. That's why when the thing gets tough, you stick to the plan and avoid making impulsive moves. And if you find yourself getting emotional, just stop. Take a break, step away from the screen, and reset your mindset.
So, thank you, Helen, for those incredible tips on managing daily loss. Now, let's shift our focus to another critical element of risk management, the maximum loss limit. So, this limit is like long-term safety net, ensuring that you don't deplete your account over time. So, unlike the daily loss limit, which resets at the end of each day, the maximum loss limit is cumulative. So, when you reach it, your account will be locked and your trades will be closed. So, to dive deeper into this, you have Scarlett that could actually work us through how this really works, and traders need to keep in mind as they plan their trading strategy.
Of course, Aizen, the maximum loss limit is a vital rule that often overlooked but extremely important. Essentially, it's there to prevent traders from experiencing catastrophic losses by capping how much you can lose across the life of your trading account. So let's break it down. The maximum loss limit ensures your account equity never falls below 94% of its initial balance. So if you start with a balance of $50,000, your account will be closed when your equity falls to $47,000. That's a total allowable loss of $3,000. However, it is not all bad news. If you start making profits, the limit adapts. It's giving you more breathing room as your equity grows. For example, if your account balance increased to $52,000, you will now make $2,000 in profit. Your new maximum loss limit would then allow you to lose up to $5,000. as you're essentially locking in those gains. The maximum loss limit acts as a long-term safeguard. It's designed not only to protect your account, but also encourage discipline in trading by setting boundaries. The goal is to ensure you don't dig yourself into a hole that is too deep to recover from. So here are a few specific examples. We have the case number one. Let's say that your account balance starts at $50,000, but your equity drops to $49,000 due to some market losses. You are allowed to lose another $2,000 before your account hits that critical $47,000 threshold and is automatically closed. And with the case number two, now if you're doing well and your equity rises to $51,000, you got some extra cushions. At this point, you're allowed to lose up to $4,000 before your account hits that same $47,000 limit. So to figure out where you stand, the maximum loss limit is calculated by adding the sum of your closed position and factoring in any open position that are still running. Your trading dashboard will show two key metrics. The first is the maximum permitted loss, which is how much you're allowed to lose overall, and the remaining loss, that is the loss left before your account is closed. Now, what happens if you hit that limit? Well, unfortunately, if your equity hits that maximum loss limit, the system will automatically close your account for the day. All your open positions will be liquidated, whether you're profitable or not, and you'll be unable to trade for the rest of the day. To resume trading, you would need to purchase a new trading package.
Alright, thanks Scarlett. That's definitely helped clarify the nuts and bolts of the maximum loss limit. So I believe that it's like a safety buffer, isn't it? It's there to keep you from spiraling out of control, especially when the markets get wonky. So now I imagine this proves impact different traders in different way. So, whether you're a cautious trader looking to keep their, risk low, or more aggressive trader trying to maximize profits, this system is one of those things you can't afford to ignore. So let's bring in Scarlett, our risk management expert. So Scarlett, what do you think are the most common mistakes traders make when it comes to managing their maximum loss limit? And more importantly, what strategy can traders implement to ensure they never get too close to it?
Great question, Adam. You're absolutely right. No matter what type of trader you are, ignoring the maximum loss limit can be costly. In fact, it's one of those things that sneak up on traders who aren't paying attention for long-term picture. And I say the most common mistake is underestimating how quickly cumulative losses can add up over multiple trades. Here are some key strategies I recommend to stay well within your maximum loss limit. First, you need to set stop loss orders on every trade. This is your first line of defense. Setting a stop loss means you're deciding in advance how much you're willing to lose on a particular trade. The system will automatically close your trade if it hits that number, which protects you from letting a losing trade get out of hand. For example, if you're only willing to lose $500 on a particular trade, you set that at your stop loss and you won't have to worry about it spiraling.
Two, I love that if they put in a safety belt on each trade, once you've locked in that stop loss is out of your hand.
Exactly, and then it's all about discipline. So this brings me to my second strategy, that is manage your position sizing. This is a big one. Often traders, especially newer ones, get carried away by putting too much capital into a single trade. But when you risk too much, you also risk losing a larger percentage of your account if the trades go south. A good rule of thumb is to risk no more than 1 to 2% of your total account balance on any single trade. For example, if your account balance is $50,000, you should only risk about $500 to $1,000 per trade. This keeps your potential losses manageable and well within your limits.
So that makes total sense. You're not putting all your eggs in one basket and gives you more room to breathe, right?
Exactly. It's all about spreading the risk so you don't take too big on a hit on any one trade. So the next strategy is monitor your account equity regularly. This may sound basic, but it's incredibly important to keep an eye on your account equity throughout the day. It's easy to catch up in the market high and low, but you should always be aware of how close you are to your maximum loss limit. Your dashboard makes it easy to check your remaining loss, so use it. If you see that you're getting close to the limit, it's time to take a step back and evaluate your strategy.
So in terms of like watching a video guide, you don't want to be driving on fumes without knowing it.
Exactly, and no one wants to get stuck on the side of the road. The next strategy is to create and stick to a trading plan. Having a well-thought-out trading plan is one of the most powerful tools in a trader arsenal. This one should outline not only your profits goal but also your risk management rules. For example, if you have a few losing trades in a row, then your plan tells you to take a breath, reset, or change your strategy. The idea is to have a reset series of rules so you don't make impulsive decisions in the heat of the moment.
Are you having a roadmap, where you're going and you have the contingency plans for when things don't go as expected?
Exactly, the market can be unpredictable, but a solid plan keeps you grounded. The next strategy is to regularly review and adjust your strategy. Even the balanced plan needs to be reviewed and tweaked from time to time. If you find you're approaching your maximum loss limit too often, this may be a sign that your risk management strategy needs adjusting. Maybe you need to tighten your stop losses or review your trade size. The key is to stay flexible and adapt to changing market conditions while always keeping your risk in check.
So that's great advice, Helen. It's all about constant improvement. So I believe you can't just accept it and forget it. You've got to be ready to adjust based on your results on the market, right?
Absolutely, trading is dynamic and your strategies should be too.
So thanks to Scholar and Helen for such a considered breakdown of the maximum lot limit. So next up we are going to enter a short break, and after that we're going to continue exploring some of the trading rules that we have and the promotional plans that we are currently running.
Rất sớm nhỉ?
copy trade. Copy trade. Copy trade. Copy Trade. Copy Trade.
So welcome back everybody. So next up we are going to enter our next key topic, the profit consistency rule. So this rule is critical for ensuring long-term sustainable success in trading, as it helps managers to maintain consistency in your profits. So now to give it a clear picture of how profit consistency works and why it's important, so let's turn to Scarlett. So Scarlett, can you break down the rules for us? How's it calculated and why it's so important for traders to focus on the consistency rather than just aiming for big wins?
Across Aiden, the profit consistency rule is a powerful metric that helps you understand how stable your profits are over time. It's not just about making big gains on 1 or 2 good days, it's about being consistent day in and day out. So here's how the profit consistency rule is calculated. You take your highest single day profit and divide it by the total of all your profits and losses over a given period, usually a month or a quarter. You then express that result as a percentage. Let's go through an example. Say your best day brought in $200 in profit, but over the month, your total profits and losses add up to $410. In that case, your profit consistency ratio would be about 48.7%. This ratio shows how much your performance comes from one standout day. Ideally, you want this percentage to be lower, under 20%, because that means your profits are more evenly spread out across all your trading days. Now, why is this important? A low profit consistency ratio indicates that you're not just relying on a couple of big wins to stay profitable. Instead, you're showing that your strategy works consistently over time, even on those days when the market isn't give you a big wins. This kind of consistency is the hallmark of successful long-term trader.
So that's a great explanation, Scarlett. So just to clarify, a lower ratio means that you're more likely to make steady gains rather than being overly dependent on a few good days, right?
Exactly, Eden. When you're too reliant on just a few big wins, it often means that your strategy is risky or inconsistent. You could go through long stretches where you're not making much money or even losing it. But if your profit consistency ratio is low, it shows that your performance is smoother and your trading is more predictable and stable over time.
So that's incredibly insightful, but it seems like a critical metric for any traders who's serious about long-term success, right?
Exactly, consistency is the key to sustainable profitability. Big wins are great, but if they're followed by big losses or long periods of break-even trading, it's hard to maintain momentum. With the profit consistency rule, traders can keep an eye on how reliable their strategy is over time.
So now that we've got a solid understanding of what the profit consistency rule is, so let's take in some practical strategies to help you maintain a low ratio easily under 20%. So Alan, I know you've got some great tips for it. So can you walk us through some techniques that traders can use to stay consistent and ensure that their ratio stays in check?
Absolutely, Aiden. The profit consistency ratio is a powerful indicator, but it takes careful management to keep it low. So let's talk about some practical ways traders can improve their consistency and avoid becoming too dependent on those rare big wins. One of the most effective strategies to keep your profit consistency ratio low is to diversify your trades. Means spreading your investment across different markets, asset classes, or even trading strategy. If you only trade one market, say forex or stock, you risk being too reliant on that market performance. By diversifying you reduce impact of any single loss and create more stability in your overall performance.
So that makes a lot of sense. Only when trading in, let's say the US stock market about we could really heat my consistency hard, but by adding trades and like example commodities or forex, a good balance some of that risk, right?
Exactly, Aiden. It's all about balance. Well, when one market isn't performing well, another markets may doing better. This way, your overall performance stays smoother and you're not relying on just one or two trades to pull you through. Next are position sizing. One of the biggest mistakes traders make is over leveraging. Take on a position that's too large relative to their account balance. For example, if you have a $10,000 account, putting the $5,000 into the single trade is a risky because that trade goes south, you could lose a significant portion of your capital. Instead, aim to keep your position size more and manageable, say lower than from 1 to 2% of your account balance per trade. This reduces your risk and have ensure that losses don't overwhelm your profit.
So that's not just about picking the right trade, but also making sure you're not putting too much of your capital at risk on any single trade. So it's smaller, more controlled trade with less steadier results over time, right?
Exactly. By managing position sizing, you prevent any single trade from having too much impact on your overall performance. It's all about control and discipline. Another crucial element is having a well-defined trading plan. Without a plan, it's easy to get caught up in the emotion of trading, whether that the excitement of the potential win or the panic of shooting loss. A smoothly planned outline exactly you will enter a trade and your asset and how much risk you're willing to take. Having these rules in play keep your routers and have ensure that your trading decisions are consistent, which in turn have keep your profit consistency ratio in check.
So that's a really good point. A lot of traders especially need one, probably jumps into trades without a solid plan and end up making emotional decisions, right?
Absolutely, Aiden. It's so easy to get emotional in the heat of the moment, but if you have a plan, it's much easier to stay disciplined and avoid impulsive trades that could hurt your performance. This brings us to stop loss order. A stop loss is an automatic asset that you set up to close a trade if it moves against you. This helps to cap your losses on any single trade and protect your account balance. By using stop loss order, you can avoid the catastrophic losses that can throw up your profit consistency.
So I like the ideas of using stop loss orders to sound like a way to take the emotions out of the decision-making process.
Exactly, it's like setting up a safety net. Once your stop loss is in place, you don't have to worry about watching the trade 24/7. If things go south, the stop loss takes you out of the trade automatically, helping you to stick to your plan and avoid large unexpected losses. Another important strategy is to regularly review your performance. Just because you set up a solid plan and strategies doesn't mean you should put everything on autopilot. It's crucial to track your trades, see what's working, and make adjustments as needed. You might find that certain markets or strategies are delivering more consistent results than others. By keeping a close eye on your performance, you can tweak your approach and improve your consistency over time.
So it's like performing maintenance on your trading strategy, always looking for ways to optimize and improve.
Exactly, just like car needs regular tunes-up, your trading plan does too. Continuous improvement is key to keeping your profits steady. Finally, and this is the big one, you should avoid emotional trading. Whether it's fear after a loss or overconfidence after a win, emotions can lead to poor decision making. If you stick to your strategy and avoid chasing losses or getting overly excited after a good day, you'll see much more consistent results.
So that is such an important point, staying calm and disciplined even when the market is going crazy. But it is easier said than done though, right?
It definitely takes practice, but staying level-headed is crucial for long-term success. If you can control your emotions and stick to your plan, you'll be far more likely to maintain consistency profits.
So, sure thing. So, next up we are going to dive into another crucial aspect of effective trading, the risk and sensitive rules. This rule is key to maintaining both stability and long-term profitability in your trading account. So, Scholar, I know you've got a great way of explaining it. Can you walk us through what the risk and sensitive rule is and why it's so important for traders to follow?
Sure thing, Aidan. The risk consistency rule is all about ensuring that you manage your risk in a disciplined, consistent manner. It limits the risk per trade to no more than 2% of your initial account balance. This is really important because it prevents large swing in your equity and helps mitigate the risk of significant losses due to sudden market movements or unexpected events. So let's break it down a little more. About the maximum risk per trade idea, you shouldn't risk more than 2% of your initial balance on any single trade idea. This includes any floating losses, so you need to factor in all potential exposure. Next is the trade idea definition. Multiple trades on the same assets in the same direction are considered a single trade idea. On the other hand, trades on different assets or in opposite directions are treated as separate ideas. For example, if you open several positions on gold buy, they would count as one trade idea, but the combined risk must remain under 2%. But if you have a gold buy and a TPY sell, they are treated as two separate ideas, each with their own 2% risk limit. Following this will smooth out your equity curves, encourages disciplined trading, and most importantly, reduce the chances of massive losses.
So, great Scarlett, I know that you got some might be wondering who to make sure you actually stick to the through. So let's focus on getting to some practical strategies for making it easier to follow. So Alan, could you share a few tips on how a trader can stay disciplined and avoid breaking the risk consistency rule?
Absolutely, Aidan. The main points to remember about the risk consistency rule are First, that is the risk per trade idea. Stick to risking no more than 2% of your initial account balance on any single trade idea. This keeps potential losses manageable and ensures you don't risk too much on any one trade. Next up, we have the single trade idea. If you're opening multiple trades on the same asset and in the same direction, you count as one trade idea. So your combined risk must stay within that 2%. And we have the separate trade ideas. That is, trades on different assets or in different directions are considered separate ideas. Each of these can have its own 2% risk, but be mindful to keep track of them. So why does this matter? It stabilizes your equity curves by preventing huge swings in your account balance. And it also promotes discipline by encouraging traders to think more carefully about their risk. And most importantly, it reduces the risk of major losses that can really hurt your overall performance. So in short, adhering these rules helps keep your trading accounts safer and support long-term success.
So let's shift gear and get into some practical strategy to make it easier to follow. So how did you share tips on how traders can stay disciplined and avoid breaking the risk consistency rule?
According to Aiden, stick key to the risk consistency rule takes some planning and discipline, but it is totally doable with the right strategies in play. Here are some few key tips. For the first one, define risk limits. First and foremost, clearly set your maximum risk per trade idea to stay within the 2% limit. You can use risk management tool or calculator to help with it. Most platforms have a built-in tool that allow you to automate risk limit.
So that's a good point, having that automation takes a lot of the pressure off, right? No need to constantly double check. Your platform does a heavy lifting.
Exactly. It makes so much easier to stick to your risk limits when the platform is handling the number for you. For the next tip, monitor position sizing. It's also important to keep track of the total risk across multiple trades on the same asset. For instance, if you open several positions on a go buy, make sure the combined rate for all those trades doesn't exceed 2%. This is why the traders sometimes leave up. They open multiple positions without realizing that combined they risking more than they intended.
So even though the trades are technically separate, if they're on the same asset, you have to look at them as one entity, right?
Exactly, Aiden. Treat them as one ideas because they are exposed to the same market movement. To make it separate trade idea. Speaking of different trade, it's equally important to trade on different assets or in opposite direction as separate idea. This way, you can manage each trade risk individually without exceeding the 2% rule on any single trade.
Right, so you could be running a gold buy and a GBP wind downs at the same time without violating the rules. So as long as you manage the risks for each one separately.
Exactly. Just make sure you keeping an eye on the risks for each idea individually. The next tip, use risk management tool. I also recommend your risk management feature that many trading platforms offer, like automatic position sizing or stop loss order. This tool can help control your exposure and prevent you from overextending your risk.
So, and I imagine these tools really help prevent those moments where you tend to take on too much risk in the heat of the moment, right?
Absolutely, it takes the emotions out of the equation and help you stay disciplined. And the last key, the regularly review trades. Lastly, is make a habit to regularly review your trading activity. This is something a lot of traders neglect. Doing your trade help ensure that your risk per trade idea remain within the set limit. And if you notice any pattern or area where you're taking on too much risk, you can adjust your strategy to stay compliant.
So it sounds like regular check-ins are crucial to spotting potential issues before they become big problems.
Exactly, Aiden. It's all about staying proactive.
So great tip, Helen. Now I'd like to move on to another incredible section for those who are bringing this brew for the first time, except for the new PC package, there's a two options available to customers. So you can choose to reset or reactivate the account. Okay, so next up we are going to walk you through the streamline payout process. So at WeMasterTrade, we believe in making this easy as possible for you to access your hard-earned profit. So we offer various options for everything. Payouts including bank transfer, PayPal and cryptocurrencies like USDC to ensure flexibility and convenience.
Yes, and a payout process is both fast and secure. After you make a profit and meet your payout requirements, you can simply log into your account, request a payout, and follow the on-screen instructions. Our team will process your request promptly, and in most cases, you can expect to receive your funds within 24 hours. It's that simple. And if you ever run into any issues or have questions about your payout, our customer service team is always here to help. You can reach us via LiveStream, email, or through our support ticket system on the website. We're committed to ensuring a smooth and hassle-free experience for all our traders.
So, at WeMasterTrade is transparency is a key part of our philosophy, and that's why we always here to answer any question you might have about your account or the payout process. So feel free to add in the comments, and we'll address your query as we go. So next up, we would like to introduce you to one of our powerful tools, the financial instrument of WeMasterTrade. So I hope that Helen could help us understand more about this.
Okay, welcome to the simple overview page of WeMasterTrade. Here you can explore the comprehensive list of financial instruments available for trading, including cryptocurrencies, forex, stocks, metal, energy, and indices. Our platform offers clients the opportunity to trade with demo account using virtual fund, and we also utilize exclusive algorithm to copy your trade to our live trading account. On this page, you will find detailed specification for each trading symbol, including contract size, margin percentage, leverage option, and commission detail. It's important to note that due to the market fluctuation, some symbols may not always be available for trading.
So, our vision is to foster a thriving community of elite professional traders, positioning WeCopyTrade and WeMasterTrade.com as a go-to platform for anyone serious about advancing their career. Whether you just getting started or have years of experience under your belt, we are committed to providing opportunities and resources to help you succeed at every stage of your trading journey. So at WeMasterTrade, we understand that each trader's needs are different, and we're here to support you with the tools, insights, and personalized packages that cater to your specific trading goal. So if you are ready to take your trading to the next level, you definitely want to stick around to hear about the exciting offers we've got lined up. The new promotion plan we'll be unveiling today is specifically designed to help traders get more out of the experience with WeMasterTrade and WeMasterTrade.com. So we are focused on creating more opportunities for growth, increased profitability, and long-term success, no matter where you are in your trading journey. So, alright, and for traders who are looking for a way to keep more of your profit, well, today we have an exciting update that will help you increase your earnings without changing your trading style. So it's about boosting your profit split by simply choosing the right funding package. So Alan will break it all down for you.
Okay, the new update is something that every trader should know about. When you put in the effort to grow your account, goodness, it's amazing to actually keep more of what you earn. Well, now there's a new profit sharing boost. That's exactly what's happening.
Absolutely, Helen. I know that one of the most common frustrations in trading is feeling like your hard work isn't rewarded enough. But now with this bonus profit sharing feature, you can actually increase the percentage of profits you keep. It's a total game changer.
So let's get straight into the details. So here you can boost your profit split and earn more. So when you invest in an instant funding package over 175, you got 1% bonus in profit sharing, and over 350, you got more than 3% of profit bonus in sharing, and over purchasing over $500, you get more than 5% of bonus profit sharing. So Helen, can you help break this down in a real example?
Of course, Aiden, let's take a look at the $500 funding package. Normally, with the instant funding, you start with 50% profit share, meaning that for every 1,000 in profits you make, you get 500. But with the new promotion, when you choose the package over the $500, your profit share jump from 15% to 55%. That means instead of taking home $500 from that 1,000 profit, you now keep the $550. And why that might seem like a small chunk at first, think about now that's add up over time, especially for the consistent trader. So inside the bigger package, the bigger your provision boost.
Exactly here. And traders, here's why this is a smart move. Let's say you're someone who trades consistently and makes $5,000 in profits over time. With a standard 50% profit share, you walk away with $2,500. But with a 55% push, you now keep $150,000. That's an extra $250 in your pocket for simply choosing the right package. And the best part, there's no extra effort required. You don't have to change your strategy or take unnecessary risks. All you need to do is select a higher funding package and you'll instantly start earning more from the same trades.
So now, so you might be wondering, why is it such a big deal for traders? So let's hear from Helen on this.
As a trader, our goal is always to maximize return while minimizing risk. The best way to grow your account is to keep reinvesting your profits. But that's only possible if you're getting a bigger share of what you earn. With a higher profit share, you can scale further, compound your earnings, and have more capital to work with for your next trades. Think about it. If you keep a larger percentage of your profit, you have more flexibility to diversify your trade and try new strategy and even withdraw more funds. This is especially important for those who want to trade for long term. Over time, this small percentage increase add up to thousands of extra dollars. So if you're someone who takes trading seriously, this is a huge opportunity to level up your earnings.
And that's such an important point, Helen. And from a psychological perspective, knowing that you're earning more per trade can actually help you stay disciplined and focused. Instead of overtrading or taking unnecessary risk to hit bigger profits, you can trade smarter because you're already keeping a bigger share of what you make. Plus, this isn't about individual benefits. The more traders take advantage of this offer, the stronger our trading community becomes. More capital means better trading conditions, more opportunities, and a stronger ecosystem for everyone.
So, alright traders, you've heard it from the expert. The only profit sharing offer is your chance to increase your earnings without changing your trading style. All you need to do is choose the right funding package and you'll instantly boost your profit split. Visit WeMasterTrade.com now and grab your instant funding package.
And guys, this is an opportunity you don't want to miss. The market is all about making smart decisions, and this is one of the easier ways to maximize your return. If you're serious about your trading journey, this is a no-brainer. Don't wait too long because opportunities like this don't come every day.
So next up, we are going to enter the economic analysis of today's calendar. Can you help me with this, Scarlett?
Yes, sure. About the news calendar for today, well, at 12 a.m., we will have the FOMC member worker speak. This is a high-impact event. Workload is a no voice within the Fed, and markets watch closely for any clues about the interest rate outlook. If he adopts a hawkish tone favoring rate hikes, CUSD might strengthen. A dovish stand could weaken the dollar. Traders should watch for comments on inflation and economic resilience. At 8:30 a.m., we will have the monetary policy meeting minutes. The RPA meeting minutes provide deep insights into the central bank's current policy stance. If the minutes show concern about inflation staying sticky or strong job data, the AUD may gain on expectations of further tightening. On the other hand, any signs of a pause or dovish shift could lead to AUD weakness. At 1 p.m., we will have the key labor data releases. First, about the climate constraint. Well, it's actual at 18.7K. The forecast will be around 30.3K and the previous is 44.2K. This is a positive surprise. Fewer people claiming unemployment benefits, signaling labor market strength. Next up is the average earning index. The actual is 5.6%, forecast is 5.7%, and the previous is 5.6%. Wage growth remains strong, although just below expectation. This could keep the Bank of England cautious. Strong wage pressure inflation, but the slight dip may reduce urgency for more rate hikes. At 4 p.m., we'll have a German due economic sentiment. Actual is at 10% and the previous is 51%. A massive drop. This suggests that investors and analysts in Germany have turned sharply pessimistic. This could be a warning sign for the broader Eurozone economy and is likely to weigh on the euro in the short term. At 7:30 p.m., we'll have the inflation data CPI series. First is the CPI remain 0.7. The second is the median CPI YY around 2.9%. Next up we have the trimmed CPI YY which is 3% and the common CPI is 2.5%. This shows persistent inflation, especially in the June CPI rising and underlying inflation signal. If this trend continues, the Bank of Canada might lean toward further rate hikes. This supports CAD strength. Next up, we'll have the USD Empire State Manufacturing Index. Actual is at minus 12.8, and the previous is minus 20. Still in negative territory, but a bit better than last one. This suggests manufacturing in New York is slowly improving, but economic activity remains weak overall. May have more bearish pressure on USD offset by hawkish Fed talk. So about the summary outlook for the USD, that is the mixed signal. Fed speech is key. For the GDP, that is about the labor data strong, wage slightly soft. It is equal to the neutral to mildly worse. For the euro, that is the sentiment collapse, which is the bearish EUR. And for the AUD, will awaiting reaction from RBA's tone, and for the CAD, inflation sticking, which is equal to the bullish CAD.
So thank you, Scholar, for such an in-depth analysis of today's economic calendar. And thank you to our audience for joining us today. So we hope the session has been informative and as we are as excited about these opportunities here at WeMasterTrade as we are. So remember to like, subscribe and share the live stream with others who might benefit from it. And don't forget to follow us on our social media platforms for more updates, promotions and training tips. Especially it's our X platform. So stay tuned for our upcoming events and we look forward to seeing you again soon. Until next time, happy trading!
We copy trade.